While Wall Street was calling the top in gold, central banks were quietly doing the opposite. China kept buying. Experts called the pullback a buying opportunity, and some believe the global monetary system is already changing. Here's why this story could matter far more than most investors realize.
According to the government's inflation report, the cost of living is now rising at its fastest pace in 3 years, 4.1%, which has the market bracing for the possibility that the Fed hikes rather than cuts. And according to the CME FedWatch tool, traders briefly put the odds of a hike to September around 70%. Now, at the same time, the other half of the market went the other way. Oil erased all of its wartime gains as the Strait of Hormuz reopened on progress towards an Iranian peace deal. And the AI trade came roaring back with Micron's blowout, its outlook lifting the NASDAQ. So gold gets squeezed. The Bank of America pulls its $6,000 gold target. That is the backdrop. Here's what the people who do this for a living made of it. And we'll start with the why. Now, the Fed has a new chair this month, Kevin Warsh, and his first move was a hard turn, higher for longer, with the whole committee behind him. Former Fed insider Danielle DiMartino Booth says that shift and what it could break matters more for gold than any single inflation print. Take a listen.
If Warsh is going to kind of be the new sheriff in town and maintains higher for longer, and thereby helps facilitate a blow up in the private credit market that bleeds into the private equity market, then yeah, this was a great buying opportunity for gold, because it doesn't matter where inflation is per se, because in times of financial crises, gold is where to hide.
And the crisis she's watching isn't in the stocks everyone stares at, it's in private credit markets.
We're seeing a lot of serious pain points in the economy that would be exacerbated greatly should rates stay where they are. So, he may get his boss's wishes taken care of sooner than you would think if the market is going to force the Fed's hand by way of something continuing, because private credit's already blowing up. Private equity is following it. But let's see if it bleeds into the public markets. But at the end of the day, you have to give Kevin Warsh credit, because he had a unanimous vote. I mean, that was absolutely shocking. And I suspect that some of the gray hairs in the audience, by the way, including Jay Powell, were probably barking like a seal with happiness that he wanted to go back to being a more succinct institution that leaks less.
Before we continue, if you enjoy fact-based analysis on gold, global markets, and the future of the financial system, make sure to subscribe and turn on notifications. Every week, we bring you insights from some of the world's leading macro investors and economists. Now, here's the key point. This discussion isn't just about today's gold price. It's about whether the global monetary system is gradually shifting away from the US dollar. If that trend continues, the demand for physical gold could remain much stronger than many investors expect.
So her point, hawkish Fed that holds rates high could be the pin, and gold is the hiding place, which sets up the question every guest came back to. If the risk is real, why are they still buying? Now, we also had fund manager Lawrence, or Larry as we call him. Lepard answer was the kind of bluntest of the week. He says we are nowhere near the end of this. Take a listen.
I know which side of this I want to be on. I mean, I do not, in my opinion, we are in a bull market for silver and gold, and we are in the third inning, not the ninth inning. So, because this inflation issue has really not been resolved.
Now, his reasoning starts with a Fed he says is trapped by the debt.
You can't shrink the balance sheet, because if you do, the debt collapses, the entire structure collapses.
All right, which leads us to his one rule, I guess, for the whole era.
I think we've got inflation baked into the next 5 years at least, maybe longer. And the implications of that, as all your listeners know, is you want to own things that can't print and inflate. And silver and gold are at the top of the list, and Bitcoin's in there too.
All right, so third inning, not the ninth. Hold that thought, because the next guest takes it from a trade to a whole new monetary system. Now, the deepest take of the week came from Frank Giustra, a guest of this show, who argues that the pullback is noise and that the real story is a monetary system being rebuilt underneath of us.
Copper can easily go from what is a $6.20 a pound right now. It could go to say $8, $9, $10 a pound. Gold, on the other hand, could pick a number. Gold can go from 4,000 to some crazy number because it's part of the monetary system, and we know that the fiat experiment as we know it is falling apart. That experiment's over, and so now, so gold has a different upside dynamic potential than copper does. So you buy gold for a different reason than you buy a copper.
Now, his evidence is in who already moved.
They have a strategic objective to switch reserves from dollars to gold, and that's happening. And I think you said something about the amount of gold. Foreign central banks own more gold than U.S. dollars now. And a big part of that reason is because gold's gone up in value. Obviously, the value of those ounces of gold have gone up, but who would have predicted that, 10 years ago? But here we are. It's happening.
Now, his line on the dollar's loss privilege struck with me.
But seriously, the petrodollar, if it goes away, because it was an exorbitant privilege that was given to the U.S. to have their reserve currency and then the petrodollar. And they've treated that privilege like an abused wife, okay, a battered wife. And so I think that we're going to see this change, but you're going to see the United States react very harshly to those that try and exit the U.S. dollar petrodollar system.
Here's why this one lands right now. Just this morning, Frank emailed me 2 words, told ya, and attached this.
Maybe anywhere. It's all about the interest rate. Lower the interest rates, you can have all the housing you want. But you have to understand, I don't want to hurt people that own houses too. These people, for the first time in their lives, they have valuable houses. They become rich. I don't want to hurt them either. Sir, what you want to do is what good for everyone? Get the interest rates down. We have this numbskull that was the head of the Fed before, and he's a stupid person. And we call him too late because he was too late with the interest rates all the time. We need low interest rates. Low interest rates will solve everything. We'll solve that. Now, despite that, we're doing well with housing. But where we're really doing well is oil is plummeting and costs are coming down, affordability.
One lesson connects every expert featured in this discussion. Short-term price movements often dominate the headlines, but long-term investors tend to focus on broader economic trends. Whether it's central bank buying, inflation, or monetary policy, these are the forces they believe will shape the next major move in gold, not a single week of market volatility.
All right, now Justro's argument is that the political pressure to push rates lower to keep housing and the system moving, even at the dollar's expense, is exactly what ends up driving gold. Now, this week, you heard that pressure in the president's own words. You decide what it means. And here's the part of the story you won't see in Western headlines. As the price fell this week, China's banks did the opposite of panic. According to the Chinese state media, major lenders, including ICBC and China's construction bank, are cutting or waiving the fees on their gold savings plans, lowering the minimum buy-ins and extending trading hours, all to make it easier for ordinary savers to keep buying the dip. Now think about that. While Western money was heading for the exit, the world's biggest gold market was lowering the turnstile. That is the counter-cyclical demand that the bulls on this show keep pointing to happening in real time. Now, the economist who called the housing crash, David Rosenberg, says that the bull market isn't broken, it's just breathing. I asked if the bull market was over after the sell-off, and he doesn't even blink.
No, I think the bull is still alive. Nothing goes in a straight line.
Now, his tell for why the floor under gold is solid is the buyer that never left.
What else has changed with gold? Really, what's changed? I mean, it's still the beautiful, shiny, malleable metal that never changes its characteristic. This had nothing to do with the dowry season in India or really about Costco selling its nice little bars. Yeah. This had to do with the central banks. You either invest along the central banks or you don't. I choose to. So until that changes, and remember, it was the central banks that ended. The central banks caused the 20-year bear market, and then it caused the end of the 20-year bear market back in 1999.
All right, but he also had warnings, too, aimed at the other side of the trade, the AI winners everyone piled back into this week.
But I would say right now, and for anybody sitting on these winners, especially in the semiconductor space and the AI space, remember that it's only a paper gain until you sell. I don't have, so as you're asking me about, my philosophy is I am not a momentum trader. I do not invest that way. That's not even investing. I'm not counting cards in Vegas and doubling down. I have never been scared to take profits. I enjoy taking profits. That's when you make your money.